Greetings. We are back to recap the first quarter of 2024. Time flies. And what a quarter it was. It was pretty good. A bull and 3 cuts is what we're calling this. This might be a little longer because it is a quarter end. So I'll loop in the month that was and then look at where we're currently at in the cycle. It definitely is a bull market. I don't know how many people expected that coming into this year, coming off a pretty good 2023. If you go back further, most people thought things would get worse going from a horrid year in 2022 to 2023. And as I've wrote in the past, and it sounds very simplistic, but really bad years in financial markets often are followed by good years. And I know that comes off as aloof, especially when you reconcile headlines and all the things people are worrying about right now as far as geopolitics and the level in which U.S. large cap stocks are trading. It's an election year, all of these things that you can pile up. Markets have been pretty resilient, and the Fed has gotten a lot of slack for the way they handled inflation. They were probably too late in hiking rates. Some say they're too late in cutting rates, but it finally seems like market expectations and what the Fed is saying have aligned. And I think they've settled on this narrative of 3 cuts in 2024. Right now, the market is pricing that in for June. So with all that said, let's get into the slides. All right. So this is Wednesday, the 27th of March. So tomorrow is the last trading day of the month. We have Good Friday this coming Friday, the 29th, and the market is closed. So this is the second to last trading day in March, and this is where we currently stand. And a few things speak to me here. One is international developed stocks. Think Australia, Canada, Greater Europe, and I know Europe's not a country, but that's the area, have started to perform better. Some of these out-of-favor asset classes are starting to perform better, and you see that here with international. You see it here with small cap value, and then here is the S&P. I don't have the Dow Jones on here, but you strip out some of those large tech stocks, and then you basically get the Dow, and it should be somewhere in here. But bonds are starting to behave a little bit better. This is a corporate bond ETF. This is emerging markets, short-term treasury ETF, intermediate-term treasury ETF, and real estate is still dragging in the rear. But all in all, a really good month. Usually March is not historically a strong month, so it's good to see the momentum continue. So again, this first quarter has been pretty strong and resilient as the Fed and market expectations align on the number of cuts and inflation continues to come down. Although inflation, especially once you get down to near that 2% target, it's going to be choppy. There's going to be false starts. There's going to be spikes in inflation. There's going to be better inflation reports. And I always kind of chuckle at the notion inflation is sticky. Inflation is always bouncing around. If you look at the history of inflation, it's very noisy from month to month. So that's just a normal function of that metric. And again, you can argue with how the government reports inflation and what's included in that, but I think that's a different conversation. Just know that inflation, noisy month to month, it's got some components that can swing pretty wildly. That's quite common. All right, so we're going to talk credit spreads, and I'm going to move my face here. So credit spreads. So this is one of our most important and closely followed inputs. I talk a lot about our rules. This is a big one, okay? And essentially what this is it's a measure of borrowing costs for investment grade companies and lower quality companies. So an investment grade company would be like a Walmart, an Amazon, an Apple. The cost for those companies to go out into the market and issue debt and borrow money. On the other side, lower quality bonds or high yield is a lower quality company. Maybe it's a junk company, non-investment grade. What is their cost of debt as they go to the market to raise funds? And in general, this has shown to be a proxy not only for stress in the economy. So when these lines are moving higher, that typically corresponds with the period of economic stress. Tech bubble here, right, in 2000, investment grade bonds are going to be less volatile, right, because these are more stable, solid companies. But this green line, again, represents lower quality companies, which can go bankrupt, which can fall short in paying their debt. Their credit spread spikes or cost of borrowing can fluctuate wildly during times of stress. So back during the financial crisis in 2008, look how crazy this spike up is. So this is a measure of stress. As these lines go up, that signals stress in the economy. The flip side of this is future equity returns tend to be best once these credit spreads peak. All right, and that goes back to my opening comment. When there's stress in markets, stress in the economy, usually future returns tend to be higher, because when there's stress, you would assume market prices go down, stock prices go down. When stock prices go down today, usually future returns are higher tomorrow. The flip is also true. The higher today's returns, the higher stocks move today, potentially lower future returns tomorrow. Okay, so when you look at this today, credit spreads, the cost for investment grade companies in blue, lower quality companies in green to borrow is really tight, meaning there's not a lot of stress in the economy. Companies can go out to market and for a slight premium above treasuries, which is like the risk-free rate, can borrow relatively cheaply. Okay, so this tells me two things. The market's not worried about a recession just yet. And two, I mentioned credit spreads peaking and future equity returns being higher, future stock returns being higher. When credit spreads are really tight like this, future stock returns could be lower. And I'll provide some additional context here in future slides. All right, so this goes back to March of 23 all the way up to last Friday's close. And again, I'll move my face because I have a big face. And what this is, the blue line is the S&P 500, right? So this is the S&P level. In March of 23, it was trading just under 4,000. Now it's just over 5,000. And then the red line is the high yield spread. So basically what I just showed you, but it's inverted. And what this shows is these two lines, the S&P and the high yield spread inverted, track very closely. Okay. And again, this is the high yield spread. So again, it's inverted. So the further down we go, the wider those spreads become, which signals stress. So think back to, let's just look here, October of 23. These high yield spreads widened a bit. Markets went down slightly. But for the cycle peak, so let's call this the cycle peak in the fall, future returns after these spreads widened out and eventually peaked were actually pretty good. And the same thing happened in the spring of 23. These high yield spreads went down or peaked, and future returns were pretty good. And conversely, as high yield spreads tighten, meaning the cost of borrowing for lower quality companies is less, or those spreads tighten, you can see stock returns tend to follow that nicely. So this is a pretty good fit line. When spreads get tighter, that tends to be good for stock prices. And then no one can tell these inflection points, but they're obvious in hindsight. When high yield spreads hit the cycle peak, from that point on, future equity returns tend to be pretty good. Perhaps this is a jumbled way to show it, but I think this next graph is a bit better. So what this is, same thing. In red, we have the high yield spreads in the 10th percentile relative to history. So 10th percentile, that's roughly where they're currently at. So we go back to 1997 and look at high yield spread levels and classify them by percentile. And then this is the S&P 500. Okay, so what we're trying to view here is, given where current high yield spreads are today, what are future equity returns at those high yield spread levels? Okay, so we've highlighted in red previous occurrences going back to 1997 that high yield spreads were at their current level in the 10th percentile. So that's here, 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 and you can see where we're currently at right here in red. All right. So there's a couple loose takeaways here. In the mid to late 90s, the high yield spread level that we're currently at marked the mid-cycle of the bull market. It was a mid-cycle spread in S&P level. And you can see there was some run rate after we hit high yield spreads in the 10th percentile where they're currently at today. Kind of the same thing in the mid-2000s. So we hit the mid-cycle in 2005, markets ascended a bit higher. But you can also see once we hit this level of high yield spread, a few years later, in this case, and in this case, it might be a few months later, that kind of marked the peak of the equity market. So you can see that here. You can see it here back in 2008. You can see it going into COVID. the level of high yield spread really marked close to the top, and this is where we're at today. So I'm not saying this is the danger zone just yet. You can see in several instances in 2005, in mid to late 90s, there were additional gains to be had in the S&P, but from these levels, looking at high yield spread and how it explains future returns, we're probably closer to mid to late cycle for the S&P rather than the start of a new bull market, if that makes sense. Okay, so I've talked a lot about how projecting future equity returns is very difficult, especially in the short run. Not so for bonds. So, we talk a lot about fixed income, a lot about bonds. 70 to 80% of our clients are retired or about to retire. So fixed income bonds are going to be a staple in their portfolios. And bonds have caught a lot of flack over the past couple years because it's been a horrid stretch. Higher inflation, higher rates are bad for all asset classes, and we saw that in 2022, especially bad for bonds. And in many cases, bonds experienced larger drawdowns than equities, especially when you got into the longer maturity bonds. So think 20, 30-year bonds. As rates go up, as inflation goes up, those longer maturity bonds are really sensitive and can see their price decline 20, 30, even 40%. So now that the dust has settled, it certainly was painful going from 0% to 5% Fed funds in a relatively short period of time. Now it looks like the Fed has paused with the expectation that cuts are coming. Okay, so back to bond returns. Bond returns track very closely to their current starting yield. And one of the proxies that we use for current starting yield is the 10-year Treasury bond, which is yielding right around 4.3-ish%. So what this graph shows is what the current yield to worst is, which I don't need to get into that, but roughly current yields are at any point over the last 40 years, so since 1976, 50 years, and in the green, what future 10-year forward returns are for bonds. So in blue, you have starting yield, green, 10-year forward returns. And you can see these lines track very closely. And the line is downward sloping because this point here in like the late 70s and early 80s marked really the cycle high for rates. But as rates went down, you can see this blue line is pretty closely fit with the green line. All right. So if I'm looking at this today, and this only goes to 2014, but if I'm looking at this today, like I said, 10-year Treasury yield, roughly 4.3%, a reasonable expectation for future bond returns annualized over the next 7 to 10 years, let's call it, could be 4 to 5%. Okay. So instead of being a detractor, instead of being a headwind to total returns, a balanced investor, a diversified investor, a retiree might see fixed income or bonds be a tailwind or accretive to total portfolio returns for the next 7 to 10 years. Okay, the drumbeat is growing louder for the froth, the fully valued nature of U.S. large cap stocks. I published a blog last week, I believe, that talked about how most money managers, most Wall Street banks are all predicting a variation of the same thing. And I've been tracking these for a long time, and it's very rare that they all agree, which I'm not saying is what happens next, but it's very curious to me that every major institution is saying a variation of the same thing, and that is over the next 10 years, given where U.S. large cap stocks are, they're very fully valued or overvalued in some people's opinion. Future returns for U.S. large cap could be lower, and future returns for not only bonds, but emerging markets and international stocks should be better. All right, so the last 16 years, it's no secret, it's been U.S. large cap stocks and everybody else. Nothing else has come close. It's created almost a new generation of investors that think investing is as simple as just shovel money into the S&P 500, check out. And look, that's worked the last 15, 16 years. But investing is cyclical. Things that are in favor become out of favor. Things that are out of favor become in favor. And there's no flashing light that lets you know this shift is going to happen. But if you look back over 100 years of investing, it's a very common rotation theme. So what we're doing is looking at the future opportunity set and trying to make calculated bets on where we think the most attractive opportunities lie. Now, we're always going to own U.S. large cap stocks. It's not like we're going to shun those completely. But I think if you're looking out over the next 10 years, this data supports future returns could be lower. So how this reads, this bottom axis is the Shiller cyclically adjusted price to earnings ratio. And all that is, it's a fancy way of saying, let's look at how the market is valued based on a level of earnings. And instead of using 1 year of earnings, because those can be noisy, let's use 10 years, the last 10 years of earnings for U.S. large cap stocks, okay? It tends to smooth out noisy earnings. So we have price, the last 10 years earnings to understand where we're at from a historical standpoint, if we're fully valued, overvalued, or undervalued, okay? And in this vertical axis, we're showing based on where we're valued, and as we move to the right here, the higher the Shiller CAPE ratio, the more fully valued or overvalued U.S. equities are. Conversely, as we move to the left, the more cheap or undervalued U.S. equities are. Okay, so that's the Shiller CAPE ratio. In this left column, the left axis, we show forward 10-year 10-year forward annualized returns. In this left column, we show forward 10-year annualized returns. So down here is where we're currently at from a value standpoint. Further right, more fully valued. Further left, the more cheaply or undervalued. And then future 10-year annualized returns. This is where we're currently at. So the Shiller CAPE ratio for U.S. equities is just over 30. Okay? So given where we're at from a valuation standpoint, I can scroll to the left and see forward 10-year annualized returns. And I think this is before inflation. Should be around 5% based on where we're currently at, all right? And to put a bow on this, I like to use the extremes. So what about being excessively overvalued, right? A Shiller CAPE of 45. You can see forward 10-year annualized returns are actually negative. And the further right we go, there's more instances of forward 10-year returns being negative, okay? I think this goes back 100 years, all right? So again, that goes back to my early comment. The more fully something is valued today, the lower the future returns. You can look at some of these extreme levels to see that in fact is true. Now, the caveat to this is what's overvalued can stay that way for a long time. Conversely, what's undervalued can stay that way for a long time. So this is a lousy timing tool, but over a 10-year period, it does have some power in explaining future equity returns. Looking at the other extreme, when stocks get really cheap by the Shiller CAPE ratio, so when they get about 10 or under 10, you can see future annualized returns over a 10-year period are 15 to 20%. So again, a great function of future returns is what you're paying today. And what professional investors are saying, future returns are going to be lower, is supported by empirical data. Because to be honest, U.S. large cap stocks have had a really good run. This is where we're currently at. Technically overvalued by historical standards. And if you look at how retail investors are behaving, I'm getting more and more questions about, hey, should we just own the S&P 500? That probably doesn't end well. That's where the behavioral side mixed with empirical evidence can go a long way from helping investors avoid helping long-term investors avoid a performance chasing mistake, which is as old as time. Okay, switching gears here. A lot of talk about commercial real estate, and this is a known risk, which I think makes it inherently less risky, but it is a risk, especially to regional smaller banks. They have a lot of commercial debt on their books. And what this is showing is the delinquency rate over 30 to 60 days here in dark blue and the 90-day delinquency rate here in light blue. And you can see this is shot straight up. So this could be a sign of stress to come. And you can see the only period that rivals the current levels of delinquencies when looking at 90-day and even 30 to 60 days is coming out of the financial crisis. And I say coming out, this is when the market rebounded in spring of 2009, but still that there was some imbalances, and you can see the stress with commercial banks and commercial loans back in the financial crisis. So this is something to keep an eye on. And look, I always say this, folks that are investing in commercial real estate are very savvy. They're not going to throw their hands up and say, hey, man, I made a bad investment. I'm just going to write this off, or I'm going to turn the keys back into the bank. They are going to repurpose the property. They're going to turn it into housing. They're going to turn it into data centers. They're going to turn it into storage facilities, warehouse space. So know that this is going on right now. These investors are going to have to get creative because the work from home, post-COVID, things are completely different. Now, I'm not saying folks are never going to come back to work, but right now we've swung the other way, and this is going to be a time for adjustment and repurposing these properties. But certainly, this does not look good for smaller regional banks. Okay, a lot of talk about all-time highs. I touched on this in a previous post, but what this is, going back to 1929, we've outlined in blue how many all-time highs have been hit. So this goes 1929 to 2024, and you can see during bull markets, and we are in a bull market right now, hitting all-time highs is completely normal. So look at the bull market from late 80 to 2000. I mean, we hit multiple all-time highs. So, and then again, from 2013 to 2022, multiple all-time highs each year. So all-time highs are a normal function of bull markets. So you shouldn't sit on cash just because markets are at all-time highs. Markets being at all-time highs are not a reason to sell everything and raise cash and wait for a pullback. Again, all-time highs are extremely normal, and this graph shows that. So we showed I talked about, I should say, some of Wall Street's future return expectations for large cap stocks over 7 to 10 years. One thing that I like to show, and I do it at the end of every calendar year, is what Wall Street firms are saying about the upcoming year. So this data was captured by Bloomberg in December of 23. You see every major Wall Street bank, or most major Wall Street banks, here at the bottom, and their S&P price projections for 2024. And you can see all but a handful have pretty much undershot where the S&P currently is right now. So this is the S&P 500 level. As of 3/21, there was only one firm that projected a higher target than the S&P is currently trading. Most other firms were very conservative or very reserved. I think the average price expectation, when you average all these out, was like 2 or 3% for the S&P 500, and we've already blown through that in the first quarter. So again, it's still early. The market could sell off, and these firms could be right. But over the last couple of years, starting with 2023, really, most of these Wall Street banks have been very conservative, and they're prone to the same biases that retail investors are, right? If we're coming off a bad year, they assume that bad year is going to leak into the next year. If we're coming off a good year, they're assuming the good times are going to continue. So bias is something that affects not only retail investors, but professional investors as well. Okay, this last slide shows central banks set for the most synchronized rate cuts since 2008. So these black bars represent the number or percentage, the percentage of central banks across the world that are expected to cut rates this year, okay? So think back to 2022 when inflation was raging and most central banks raised rates. Now it's the other side. And the Fed is kind of late to the party. They've been one of the last central banks, major central banks, to cut rates, and they haven't cut yet. So usually the Fed is leading the global cycle. In this case, the Fed is trailing the global cycle. But all of this naturally ebbing inflation coming from a high level of inflation, going down, and then a bias to cut rates for the 11 major central banks, including the Fed, typically is a good thing for risky assets. And look, the market action over the last 12 to 14 months have sniffed a lot of this out. So it's not like we're going to wait for the Fed to cut and then markets are going to rally. This has been sniffed out by investors over the last 14 months. So again, this does potentially bode well for risky assets. It bodes well for bonds too, and some of these rate-sensitive asset classes like real estate and fixed income. As rates go down, that tends to provide a tailwind to some of those rate-sensitive asset classes. So that's the first quarter. It's kind of a repeat of what we saw in early 2023, where U.S. large caps, driven by a handful of companies, have really led the charge higher. The difference is now we have more clarity about what the Fed is doing, what inflation is doing. And again, it's nice to see stocks and asset classes outside of a handful of tech stocks start to behave better. Bonds are starting to behave better. International developed is starting to behave better. So that's where you get more breadth, and that's a greater sign of a healthy bull market. So I hope you enjoyed this. Thanks for watching. If you have any feedback, shoot us a note at insight@pureportfolios.com. We'll see you next month.